Okay, let's try and unpack this. Imagine you've just been handed, a big stack of documents, an earnings call transcript, a really detailed press release, financial reports, all from a major healthcare company. It's pretty dense stuff, right?
Definitely dense.
But what if you could, quickly pull out the most important insights, the surprising facts, and really understand what it all actually means?
That's the goal.
Yeah, that's our mission today. We're doing a deep dive into Tenet Healthcare's second quarter 2025 performance. We'll navigate their latest results, their strategic moves, and give you those key nuggets of knowledge you need. So you're well-informed, but hopefully not feeling overwhelmed.
Right.
So get ready, because this is where I think it gets really interesting.
It really is a fascinating look. You've got a company that seems to be finding its groove in a really complex, always changing healthcare world. So to start with the big picture, Tenet Healthcare in Q2 2025, they reported consolidated Adjusted EBITDA of $1.121 billion. Now, for those maybe less familiar, Adjusted EBITDA, it's basically a key measure of their core operating profit, before certain non-cash stuff or debt costs. And that figure, it's a pretty robust 19% increase over last year.
Wow, 19%?
Yeah. And net operating revenues hit an impressive $5.3 billion.
That's a really strong snapshot financially. And this performance, it isn't just a one-off thing, is it?
No, not at all.
It actually led them to significantly raise their guidance for the whole year for 2025. What does that kind of confidence signal?
Well, it's a very clear signal of, let's say, their optimism about where things are headed. They boosted that full-year guidance by a pretty substantial amount, $395 million at the midpoint.
$395 million.
Yeah, pushing the new range up to between $4.4 billion and $4.54 billion. And that actually works out to about 10% growth year over year compared to what they previously expected.
Great.
So it strongly suggests they believe this momentum they've got, it's sustainable for the rest of the year.
Right. And Tenet CEO Sam Sateria, he really hammered this point home, didn't he?
Huh.
Highlighting their track record of attractive same-store revenue growth, operational performance driven by fundamentals, and robust free cash flow generation. It really sounds like they're feeling good about their core operations.
They certainly project that confidence.
But are there any, underlying challenges or headwinds, things that might maybe temper this a bit, even for a company doing this well?
Well, look, the healthcare landscape always has challenges. Policy uncertainty, labor pressures, you name it. But their confidence does seem pretty well placed, especially, I think, when you dig into their ambulatory care segment.
USPI, United Surgical Partners International.
Exactly, USPI. That segment is really proving to be a powerhouse for them. They delivered $498 million in Adjusted EBITDA there. That's 11% growth.
Still double digits.
Yeah, and kept a really strong Adjusted EBITDA margin, too, at 39.2%.
Okay, now here's where it gets kind of fascinating for me. There's a bit of a surprising twist with USPI. While their same-facility revenues grew nicely, 7.7%, their actual surgical case volumes decreased slightly, by 0.6%.
Right.
So how do they pull that off? Increase revenue with actually fewer cases. What does that shift really mean for their business?
It's a great question, and it's really insightful because this wasn't some accidental decline. It was very deliberate, strategic. The company actually calls it a disciplined shift towards higher acuity services.
Higher acuity, so more complex cases.
Exactly. The net revenue they made per case shot up significantly by 8.3%. That points directly to a more complex and therefore a higher value mix of cases.
Okay, so it's like quality over quantity in a way.
You could think of it like that. Or like a restaurant deciding to serve fewer but much more complex, expensive gourmet meals instead of just, banging out lots of simple, cheaper dishes. By focusing on these complex, high-value procedures, but in an outpatient setting, Tenet is sort of proactively carving out a niche.
A niche that used to belong more to hospitals.
Precisely. They're moving into areas traditionally dominated by inpatient hospitals. That could potentially disrupt the market and likely boost their long-term margins as more procedures keep shifting outpatient.
Yeah, you can really see that shift when you look at the specifics. They had, what was it, an impressive 12.6% growth in total joint replacements inside their ASCs.
That's the one, 12.6%.
Ambulatory surgical centers, yeah. That's a clear indicator of moving towards those higher value procedures you usually associate with a hospital stay.
Exactly right. And they're not just, sitting back. They added 8 new centers just in this quarter, and they're strategically focusing them on high acuity stuff like spine, orthopedics, neurosurgery.
The complex stuff again.
Mm-hmm. And looking ahead, they've got a pretty robust M&A pipeline, mergers and acquisitions. They actually expect to spend more than their original plan of $250 million on M&A this year.
Oh, interesting.
And they even raised the full-year adjusted EBITDA outlook for USPI specifically by $70 million, which just, reinforces its role as a key growth engine for them.
And if we connect this to the bigger picture, the policy side, there's that proposed rule from Washington about potentially eliminating the inpatient-only list for Medicare.
Right. That's a big potential catalyst.
That could be huge for their USPI business, couldn't it? It plays right into what they're already doing, specializing in these higher acuity ASC procedures, being good at selecting the right patients.
It absolutely could. It would potentially allow them to shift even more complex cases into their outpatient centers. It could be a really significant tailwind for that strategy.
Okay, so from that outpatient strength, let's pivot now. Let's turn to sort of the bedrock of their operations, the hospital segment.
Yep, the traditional hospital business.
That area also showed some pretty impressive gains. Adjusted EBITDA there grew by 25%, up to $623 million.
That's right, 25% growth. And importantly, their margin improved significantly too by 300 basis points.
Well, 3 percentage points.
Yep, up to 15.6%, a healthy improvement.
It's interesting. We saw with USPI how they grew revenue with fewer cases. Is a similar thing happening in the hospitals, or are volumes more critical there?
Well, volumes are still important in hospitals, for sure.
Okay, because their same-store hospital admissions were up, but only slightly, 1.6%.
Right, but similar to USPI, the revenue per adjusted admission saw a healthier jump, 5.2%.
Okay. So again, it's telling a story about maybe the type of patient or the payment source.
Yeah.
Strong payer mix, patient acuity, those kinds of things.
Indeed. It really is a parallel story, another example of strategic focus. They're making pretty significant investments to expand their hospital network capacity, but also to prioritize those high acuity service lines, things like cardiovascular, orthopedics, spine, neurosurgery, general surgery, and also emergency-driven trauma care.
Yeah.
Complex needs. And they also mention a strategic focus on taking patient transfers from smaller outlying hospitals.
Which often means sicker patients, right? Needing more complex, higher value care.
Exactly. It fits the pattern.
And it sounds like they're really getting a handle on cost control, too. Their consolidated salary, wages, and benefits. SWB, only 41% of revenues. So that's a 140 basis point improvement.
It is. And get this. Contract labor, temporary or agency staff, which has been a huge headache for the industry.
A huge cost driver, yeah.
It was minimized down to just 1.9% of their total consolidated SWB.
Wow. Under 2%. How?
They attribute it to a, quote, data-driven approach to capacity and labor management, plus better recruiting and retention strategies.
That is incredibly efficient. I mean, is there a point, though, where controls that tight might start to impact, I don't know, quality of care?
Yeah.
Or staff morale?
It's always the crucial question in healthcare, isn't it? Balancing efficiency with quality and staff well-being. However, you have to look at the context. In a sector that's been really struggling with rising labor costs, staffing shortages, achieving contract labor below 2%, that's not just efficient, it's a major competitive edge.
Yeah, good point.
It suggests their data-driven approach isn't just talk. It's actually translating into operational results that, frankly, few others in the industry are matching right now. And that frees up capital for those strategic investments we talked about.
Right.
Oh, and there was another specific boost for the hospital segment, too. They recognized about $79 million in favorable pre-tax impact from some additional Medicaid supplemental revenues.
Ah, related to prior periods.
Exactly, including a newly approved program down in Tennessee. Just a good reminder of how, policy changes and state programs can directly hit the bottom line.
Okay, so we've looked at the strong operational performance in both segments. Let's dig into what's kind of underpinning all this financially. Tenet seems to be showing some serious discipline with their cash management.
They really are.
They generated, what, $743 million in free cash flow just in Q2.
That's right, which brings the total for the first half of 2025 up to $1.385 billion.
And just to remind folks, free cash flow is essentially the cash a company generates after paying for its operations and maintaining its assets. It's a really critical sign of financial health.
Absolutely critical. And what's really fascinating here, I think, is their balance sheet strength that enables. As of the end of June 2025, they were sitting on $2.6 billion in cash.
Wow.
with nothing drawn on their $1.5 billion credit line. And importantly, no major debt coming due until 2027.
That gives them a ton of flexibility, doesn't it, for future growth, investments, weathering storms.
A tremendous amount, yes. Financial flexibility is key.
And it looks like they're putting that cash to work for shareholders, too.
Mm.
In the first half of the year, they spent $1.1 billion buying back 7.2 million of their own shares.
Significant buybacks.
Once the board just authorized another $1.5 billion for more share repurchases. So they still have, what, $1.781 billion left in that program?
It's a pretty aggressive share repurchase strategy, and it certainly signals management's confidence in the stock's value.
Yeah, it really does.
And it highlights their capital allocation priorities pretty clearly. Number one seems to be growing USPI through M&A, then investing in hospital growth opportunities, especially that high acuity focus, and then evaluating, paying down debt or refinancing, and finally, this balanced approach to share buybacks.
Makes sense.
And they also noted they're continuously deleveraging, paying down debt relative to their earnings. Their net debt to adjusted EBITDA ratio is now down to pretty healthy 2.45 times.
Okay, good financial footing. Now let's shift gears a bit and talk about navigating some of those external dynamics. Things like policy shifts, payer relationships, always tricky in healthcare.
Always moving targets.
Healthcare exchange volumes, for instance. Seems like they've had a pretty significant impact. They reported a 23% year-over-year jump in admissions from the exchanges.
And a 28% increase in revenues from those patients in Q2.
Yeah, those exchange volumes now make up, what, 8% of their total admissions and 7% of their total consolidated revenues.
That's right. And this highlights a really crucial point. Why does this matter so much, you might ask?
Yeah, why is it significant?
Well, the company is strongly advocating lobbying, essentially to get the enhanced subsidies for these exchanges extended. They frame it as, a critical safety net for people transitioning off Medicaid and also important support for small businesses.
Okay, the policy angle.
But beyond that, just from a provider perspective, these exchange patients represent a generally stable paying patient population, which is crucial for consistent revenue when other coverage types might be fluctuating. It's a major operational headache across the board. But Tenet's subsidiary, Conifer Health Solutions, their revenue cycle management arm seems to have really adapted. They've deployed more technology, more automation. They've also scaled up trained offshore staff to handle the volume efficiently.
Makes sense. Technology and scale.
But what's particularly interesting, I think, is their use of AI-enabled technologies.
AI for denials. How?
Basically, using AI for faster, automated responses to disputes based on pattern recognition. The AI learns what types of denials happen, what documentation is needed, and helps automate the appeal. That's coupled with just a relentless focus on getting the documentation and coding right on the front end.
So it's a proactive, tech-driven approach.
Exactly. It not only helps them recover revenue that might otherwise be lost, but it probably positions them ahead of competitors who might be drowning in manual processes.
Yeah, it could even set a kind of standard for how others might need to manage these disputes going forward.
Potentially. It shows a level of sophistication there.
Okay, so they're clearly focused on adapting using tech. And just briefly touching on legislation. While the big impacts of that Build Back Better, or OBBB bill, seem pushed out to maybe 2027 or 2028.
Right, the timeline is fuzzy.
There's still a lot of uncertainty, right?
Right.
New proposals trying to repeal parts of it. But Tenet seems to be saying, we're sticking to our strategy regardless.
Yeah, their message seems to be, despite these external factors, our commitment to the core strategy, high acuity, operational efficiency, USPI growth that remains unchanged.
Okay. So wrapping this all up then, what does this deep dive really mean for you, the listener?
Well, I think we've seen how Tenet Healthcare is pretty strategically navigating a really complex healthcare world. They're focusing hard on those high acuity services, especially outpatient. They're leveraging operational efficiencies like that low contract labor, and they're managing their finances with a very disciplined eye. This dive really reveals a company that isn't just, reacting to the market. They seem to be actively trying to shape their future through these targeted investments and a commitment to quality care within that strategy.
It definitely leaves us with a pretty important question, I think. In this world of constantly evolving healthcare policies, information overload, shifting patient demands, what role will this kind of innovative service delivery, especially that strategic pivot to high acuity outpatient care, coupled with really robust financial management and, frankly, smart advocacy, what role will that combination play in defining who succeeds among healthcare providers going forward?